Sonal, am I audible?
Yeah, Anubhav, you're audible. I'm making you the host. Just a second. Huh? I have made you the host.
Sonal, am I audible?
Anubhav,
Yeah,
hi.
Anubhav, you're audible. I'm making you the host. Just a second.
अच्छा थोड़ा लैग से आ रहा है.
Sure. I
Hi,
have
Sonal.
made you the host. Sonal, am I audible?
Anubhav,
Yeah,
hi.
Anubhav, you're audible. I'm making you the host. Just a second. Is there a lag now or like it's correct? Like it's recent. Sonal, Sonal, you are not. You are on mute. Can you unmute yourself?
Anubhav, I was just trying to check the YouTube link, so I had muted
Okay,
myself.
okay. Sure.
Uh,
No, I'm asking that
मैं ऐसे बोल
voice
रहा
is
था.
not lagging right now. No, I'm fine.
You are
I'm
fine.
on.
You're fine. वो YouTube चल रहा था तो voice echo हो रही थी. I've muted that basically.
Okay, sure, sure.
वो there was a cancellation there basically which was happening. Hi Neeraj sir. Hi.
Hi,
Uh,
how are
Hi,
you doing?
All well
Hi,
sir.
Anubhav.
hi, Neeraj. So we'll start in some time.
Yeah.
And please forgive us if we do something stupid because I'm very technically challenged. So, like,
That's all right. Do you do this periodically, or this is the first time you are doing this webinar?
Uh,
we do
second,
this,
third time.
but
Second,
like,
third time.
Sorry?
I think second, third time we're doing this. So this
Okay.
will be more regular from here on. Different formats. We write, we do webinars, we like, uh, so
That's
kind of a
good.
free.
and the main thing is, I think we are using Zoom for the first time. We use Google Meet a lot.
You don't have a time limit with Zoom? Normally,
No,
Zoom, unless
paid
you are a
account.
corporate member,
This
is
is a paid
restricted
account.
to.
This is a paid
Sorry?
account. This is a paid
Okay.
account.
Yeah, so then it's unlimited.
Anubhav,
Sure. Hi.
yeah, since I've made you the host, I don't have the control to make the participants join in the mute mode. तो एक बार हाथ से करते रहना. Senior sir, so just to maintain order and there is no echo and void, we request you and everyone else to be on the mute mode. There'll be quick Q&A later. But Anubhav, if somebody is on unmute, you'll have to do it because I think you are the host now, basically. Okay?
Sure, sure. It's 11. I think let's wait for another couple of minutes and then we'll start.
Sure.
Uh, is a presentation visible to everyone?
Yeah.
Yes.
So now should we start or wait more?
Anubhav, please start. We can start the intro and then maybe people will start chipping in.
Sure. So good morning, everyone. Thanks for joining us today on a weekend morning for this webinar. Really appreciate the effort. I'm Anubhav and I'm one of the co-founders of Prescient Capital. Sonal, my co-founder, is also on the call. Sonal, would you like to say hi? Yeah.
Hi, everyone. This is Sonal Minhas. Good to see you all here. Thanks.
Great. So let's start. We will have a short presentation and then we will take up questions at the end. So if you have any questions at any point, maybe you can jot them down in the chat box and we will answer them at the end. So I'll start with a brief introduction of Prescient Capital. So Prescient Capital is a portfolio management service. Sonal and I are the co-founders and we are based out of Gurgaon. We run a buy and hold strategy in high quality businesses, especially small and mid cap companies. So currently, if you look like the hottest topic of conversation in the Indian stock market is how much the markets have moved up in the last 1 year, especially small and mid cap companies. And we are also getting a lot of questions around the same from our existing and as well as prospective clients, whether it is like prudent to remain invested or deploy fresh capital in the markets at the current level. So in today's webinars, we'll share how we are following a very process-driven investing approach to minimize risks in this bull run. So let's start. So we will start with a very customary slide that compares our performance since our inception in October 2019 against relevant benchmark indices like Nifty 50, BSE 500, TRI, and Nifty Small Cap 100 Index. So if you look at this dark green line, this is the performance of our strategy since our inception. And overall, we have delivered quite a decent return of 4.7x or roughly 36% kind of IRR since our inception. And this performance is net of all fees and charges. But if you look at the market performance during this period, that has also been pretty decent. Especially if you look at the performance of the small cap index, NSE small cap 100, which is this yellow line, it has also delivered a return of 3.5x over the same period. Another thing we want to highlight is that there have been several major macro negative events like COVID-19 outbreak, two full-fledged wars, rising inflation. The US Fed rates are actually at their highest level in last 2 decades, and the rate cut cycle has also not started yet. It's expected to start in September this year. But despite all of these major negative macro events happening during this last 4 or 5 years, the market has done really well. So the key learning is that macros become pretty irrelevant in determining long-term market performance. Any negative macro event may have a short-term impact or correction over 6 months or 1 year, but they are pretty irrelevant or useless over the longer term. Moving to the next slide. So this slide shows the Buffett index, which is market cap to nominal GDP for the overall Indian listed space over last 2 decades. So currently, if you look at this red column, this ratio is at its highest level in last 2 decades. So clearly, this is a red flag which shows markets are currently overvalued. Yeah. And anecdotally also, we know that markets have moved up. Like I was telling at the beginning of the presentation, that we know that the markets have moved up, especially small and mid-cap companies. So over the next few slides, we will take you through some of the indicators that will show the level of overvaluation in the market today. So if you look at this slide, it shows the distribution of companies in the BSE 500 index across different valuation ranges over the last 2 decades. So we have taken the BSE 500 index because it is a broad index and much better representation of the overall market compared to a large cap index like Nifty 50. So if you look at this column, currently more than 50% of the companies in the BSE 500 index are trading at a trailing price to book valuation of more than 5x. So a valuation of more than 5x price to book is actually very rich. And this ratio of companies trading above this valuation is at its highest level in the last 2 decades. So clearly a sign of overvaluation. Moving on to the next slide. In this slide, we will take a look at the price to earnings multiple of the companies in the BSE 500 index. So if you look at this column, as on 1st August 2024, 228 out of 500 companies. So almost like roughly 1 out of every 2 company in the BSE 500 index is trading at a price to earnings trailing multiple of more than 50x. So again, a trailing price to earnings multiple of more than 50x is actually very rich. Yeah. And if you look at 1st January 2020, only 93 companies, or roughly 1 out of every 5 company was trading at a trailing price to earnings multiple of more than 50. So over roughly last 4.5 years, there has been a massive re-rating of companies, which is clearly like evident in this movement. Yeah. Now moving on to the next slide. So in this slide, we look at the returns generated by companies in the NSE 100 and BSE 500 index over last 4.5 years, like starting 1st January 2020. So again, 359 companies out of 500 companies in the BSE 500 index have delivered a return of more than 2x since 1st January 2020. So honestly, delivering poor returns in this market over last 4.5 years or so has been difficult, because like even if you throw a dart and choose a company, like most companies have delivered very healthy returns. So so the overall, to summarize, the markets have done really well in the last 4.5, 5 years, and currently lot of companies are, and especially some specific sectors that we'll discuss later on, are clearly overvalued. So now moving on. So over the next couple of slides, we will discuss why we like the small mid-cap space, because clearly we are a small mid-cap strategy. So if you look at this chart, it shows the annual return delivered by the NSE Small Cap 100 Index, which is a small cap index, over the last decade, last 2 decades. And if you look at the performance, this small cap index is clearly very volatile. In 1 year, it gives a very high return. Then the following year, it will correct by a large amount. So clearly, the index is quite volatile, and it is representation of the volatility of the overall small cap space. But one thing we would like to highlight is that despite volatility, the mid cap index as well as the small cap index has delivered much better returns than the large cap index Nifty 50 if we look at the last 5 year and last 10-year performance ending 31st July 2024. So the message here is that if you are able to withstand volatility, then the small cap space can deliver very handsome returns for you, provided you have a long-term orientation. And for a small cap strategy like ours, this volatility is actually a boon, because it is only during like phases of market correction and volatility that we get to invest in very high quality businesses, high quality small and mid cap companies at very cheap valuations. So actually this volatility is beneficial for a strategy like ours. Moving on to this slide, so we just discussed that the small cap space is quite volatile. So given the pain associated with the large drawdown in a given year, a relevant question to ask is why invest in the small cap space? Why not restrict yourself to investing in only large cap companies, which tend to be much less volatile in their returns? So I think the main reason we believe is that the small cap space in India actually can deliver venture capital type returns with much lower risk. So in the venture capital space, obviously the startups offer very high growth opportunity. But the problem there is it is very risky because their business models are totally unproven. Their viability is unproven. Even when they get listed, they are still loss making. So if you take any example of Ola Electric, uh, like most of the startups, like they tend to be loss making, and business viability is unproven till very late in their evolution as well. But in the small cap space in India, you will find very high quality businesses that are market leaders in their niche and high growing business verticals or sectors. But despite their very high growth prospects and attractive financial, these tend to be available at very throwaway valuations from time to time. And the main reason is highlighted in this slide. If you look at this slide, the small cap space is very under researched and under owned by institutions. So that gives us an opportunity to do our research and find very attractive, high growing, dominant market leaders in the small cap space and invest in very attractive valuations. Yeah. So moving on. So now we will discuss that what are the key strength areas in our investing approach that helps to minimize risk during bull runs like the current one. So firstly, we invest in very high quality businesses that have net cash balance sheet, high return on capital, good growth prospects, and a significant portion of our portfolio companies are market leaders in their niche industries or verticals. So this leadership position and strong balance sheet ensures that they are able to like withstand volatile and tough times. So when there are market drawdowns, these businesses tend to do quite well even during phases of correction and drawdowns. Secondly, even after we have identified a very good business, very high quality business, we invest in it only when that business is available at a very attractive valuation, which is at a decent discount to its own historical valuation, as well as the valuation of its peers in different equity markets around the world. So we not only look at India, we also evaluate what valuation such companies trade at different markets like US, China, Europe, and like I said, and we will give an example of that in a later slide, that we only invest when there is a decent discount in their valuations. Thirdly, whenever a client invests in a PMS, comes on board, we deploy his or her capital in a staggered manner. Uh, Depending on the availability of opportunities and at attractive valuation. Also, we never invest our entire target allocation in an opportunity in the very beginning. We usually like invest or allocate 1.5 or 2% of the overall corpus in an opportunity at the start, and then increase that allocation over time as we find better valuations and as our conviction in the management execution grows over time. So this staggered deployment of corpus helps us preserve cash, and that is a big positive in a bull lab market like the current one, because whenever there is a correction or whenever drawdown happens, we are able to invest that capital cash lying in the portfolio in attractive opportunities. Next slide. Sonal and I have a investing experience of more than 15 years each, investing in different sectors like financial services, healthcare, manufacturing, auto ancillaries. So we have a very wide research coverage across several different industries. We know from our experience that sector returns are very cyclical in nature. So we always invest in out of favor, under research, disliked sectors or opportunities ahead of time, and then patiently remain invested in them till the time the cycle turns and we are able to make handsome returns. And this ability to rotate out of expensive sectors into out of favor or disliked industries or sectors has been one of the key drivers for our healthy returns since our inception. And lastly, we do a very thorough due diligence to check for promoter integrity and competence. I think this is our number one differentiation. We do a lot of primary research in identifying and investing in exceptional promoters. This is mainly because during a bull run, even a bad promoter or a dishonest promoter can deliver good returns just because of the upcycle. But exceptional promoters prove their mettle when the cycle turns. So we place a lot of emphasis on identifying great promoters because then the businesses will do well even when there is a downturn, both in economy and both in the market sector. Yeah. So moving on. So this slide is used to will highlight the attractive financials of our portfolio companies. So if we look at the top left chart, as on FY24 end, barring financial services companies, the rest of our portfolio companies on aggregate have 22% of their net worth as cash. So why I excluded financial services companies is because in lending businesses, of course, there will be some leverage because the business model is based on leverage. But apart from financial services and lending businesses, all our portfolio companies are net cash companies. We never invest in companies which have high leverage. Then if we look at this chart, it shows the healthy top line and earnings growth that our companies have delivered over the last 3 and 5 years, ending again in FY24, that is March 2024. This chart shows the healthy return on capital, and this is 17%, I think, post-tax return on capital, the healthy earnings growth, and the very high dividend payout of our portfolio companies over the last 6 years, FY18 to 24. And lastly, this is a very important chart because, like I said, a lot of the companies which we invest in, they are market leaders, very, very dominant market leaders in their own niche verticals or industries. The industry or the vertical may not be very large in size, and I'll take some examples of that. But within that small niche and fast-growing sector, we always try to find out market leaders and invest in them. So 11 out of overall 30 companies across client portfolios across vintages are like market leaders, and 42% of our overall AUM is deployed in market leaders. So 42% seems like a slightly low number, but again, we will have to exclude financial services, and we have a very healthy allocation to financial services at this point of time. Because in BFSI, like it's a very scaled up sector. You can't find even HDFC Bank, though it's the largest like bank by market cap in India. It will only have like Sonal, if you correct me, like please correct me, but I think it will only have like less than 5% share of uh, total outstanding loans, I suppose.
Yeah, 3 to 4%. Yeah.
Yeah, 3 to 4%. So we have to take out financial services because they are like even the largest company will not be a dominant market leader. So I'll take you through one or two examples. Like uh, this company, PM Industries, it is a market leader in two-wheeler auto lighting industry, and it has more than 30% market share of that industry. So for OEMs like Honda Motorcycles and Scooters India, TVS Motors, it is like a very dominant supplier. It supplies 70 to 80% of all their auto lighting requirements. So niche industry, auto lighting is not a large industry, but very dominant market leader in that niche industry. Again, like the NRB bearings, this is again an auto component that manufacture needle roller bearings, and it has 60% market share of that niche industry. Again, not a large industry, but fast growing and very dominant market leader of that space. So this is just to highlight the point that we always try to identify niche, fast-growing market leaders and invest in them. Moving on to this next slide. So this slide highlights the attractive entry valuation in which we invest in our portfolio companies. So if you look at these names, these are all our top performing portfolio companies which have delivered the best returns for us. And this first column, it shows the valuations in which we invested, the trailing PE valuation in which we invested in these companies. So just want to highlight that none of these businesses we invested in a trailing P by E multiple of more than 20 times. Only company which we invested at 20 times is RPG Life Sciences, which is again a branded formulation FMCG kind of business. And then next three columns, if you look at, this one, and this one, it highlights the heavy discount of these entry valuations to the historical valuation of the company itself, to the peer valuation, or like the valuation of its peer in the same industry, and to the valuation of the BSE 500 index, which is a broad-based index. At the time we made investment in these companies. So again, want to emphasize that we follow a very, very strict pricing discipline and never overpay to invest in any opportunity. We don't go after hot or fat sectors, and we consistently maintain a pricing discipline. So all of these companies, they have been we have invested in them across different vintages. So again, just to highlight that it's not like in a given year only we invested in all of them. So yeah, moving on to this slide. This table on this slide, it shows the weightage or share of different industries in the NSE 500 index over time. So if you look at a particular cell like this one, it shows the weightage of communication services industry in the NSE 500 index as on December 2014. So the color scheme of the table is to highlight this. So as the industry delivers good returns and its valuation increases, its weightage in the industry also, its weightage in the index also increases over time. And also what happens is that more and more investors want to invest in that industry. So this herd behavior of the investors also leads to increasing weightage of that industry in the index over time. So the color scheme, like I said, is representative of that. The redder a given cell is, it shows that the weightage of that sector in the NSE 500 index in that year is quite high and it is overvalued. And the greener the cell is, it shows that the weightage of that industry in the NSE 100 NSE 500 index in that year is low and it is quite undervalued. So the message we want to convey here is that clearly sector returns are cyclical in nature. So usually a phase of higher weightage and good returns is followed by a phase of falling weightage and poor returns. This is highlighted in this table by a phase of red followed by a phase of green, and vice versa also. If you look here, a phase of green followed by a phase of red. So what we want to convey here is that it is very important to have a counter-cyclical approach to investing. So we invest in sectors which are undervalued, have lower weightage, and disliked by the investor community ahead of time, and then patiently wait for them to make good return when the cycle turns. Uh, yeah, and this this ability to rotate out of expensive sectors into undervalued and out of favor sectors has been one of the key drivers of our healthy returns over time. So moving on to this slide. So in this slide, we just wanted to highlight what we just discussed, that we invest in undervalued and out of favor industries ahead of time and then patiently wait for them to deliver good returns. One example I'll take here is the capital goods industry. We invested in a number of capital goods companies like TD Power, Voltam, Bharat Bijli over 2019 to 21 when they were available at very attractive valuations. So this is because the capital goods sector, it was highly undervalued and completely hated by the investor community at the end of the decade, like in 2020. This is because India had undergone an entire decade of manufacturing downturn during 2010 to 20. So this sector had delivered very poor returns, very poor earnings growth. But we understood that this is a cyclical phenomena, and the names that I took, these are very high quality companies, sector leaders in their niche verticals, run by very honest and competent promoters, and we invested in them at throwaway valuations. And during the next 3 or 4 years, when the cycle turned, uh, we saw massive re-rating. In fact, the capital goods sector has delivered very, very healthy returns for us if you look at the returns generated by these ideas. So now, if you look at this capital goods industry, it has become the darling of all investors now. Companies are like no more undervalued. They are now trading at very rich valuations. This sector has delivered very good returns for us. So now, in fact, we have stopped investing in this sector and actually exiting out of all of these names because they have become expensive. So, like I said, we always make a conscious effort to rotate out of expensive sector and invest in undervalued ones.
So just want to jump in, Anubhav, just highlighting adding to what you were talking about. See, the idea here is that we are not um, opportunistic about entry and exit, but the more important thing is that these are businesses which are run by exceptional founders, as Anubhav said, and these exceptional founders in the period of downturn basically are not sitting idle. Just to highlight, they are in reinvesting in their R&D, they are investing in their product lines, they are investing in geographical expansion, and that gives them the edge that whenever the demand hits the industry cycle, they are at the top of their in the stack of the companies, and hence you see them outperforming in their sales growth, in their earnings growth, and hence their valuation growth basically is phenomenal. So the underlying ideology here remains that you back good, honest, hardworking, professional founders and teams at times when they are maybe at the bottom of their cycle, or they are investing in the business and hence their heads are buried in the ground. So just want to add that here. Yeah.
Thanks, Sonal. So another uh, opportunity that we identified, just want to highlight that. So we invested heavily in auto ancillary names, like we have given the names of 4 companies here: CAM, Gabriel, GNA Axles, and RB Bearing. During 2020 to 22, during these 2 years, we invested heavily in auto ancillaries. And the reason was that when during the lockdowns that happened after the outbreak of COVID-19 in 2020, the auto industry was very badly affected because during the lockdown, manufacturing stopped, production stopped for most of the manufacturing sectors. And especially for auto, what also happened is that the auto sales also plummeted because no one was buying cars or two-wheelers during these 2 years because everyone was locked in their homes. So the auto sales fell very sharply during these 2 years, and especially auto components because they are lower down in the value chain. Though all of these names are very differentiated auto component manufacturers, but they were impacted a lot, and they were available at almost throwaway valuations, like like less than their replacement value and things like that. And we invested heavily in this sector. And once, like in 2023, uh, the lockdown stopped and the impact of COVID started waning, these companies have done very well for us. In fact, this is one sector we continue to hold on because the companies have done very well for us, and even now, uh, some of these companies are available at reasonable valuations. So, again, an example of us being able to identify great opportunities when the sector was down and out. Uh, the next example I want to take is financial services because this is a recent example. Because if you look at the financial sector, services sector, even currently, it is available at very reasonable valuation. In fact, banks and financial services, apart from capital marketplace are somewhat elevated, but banks, lending companies, NBFCs, these are available at very attractive valuations. And this sector has been delivered very good returns in the last 2 years. So we are very actively investing in financial services currently also. Sonal, can you talk about this business because this is a sector you very closely look at? Yeah.
Sure, Anubhav. So, see, the underlying thesis behind investing in banking and financial services as we speak right now is that banking and financial services has come out of the whole COVID setback in a phased manner, unlike other sectors, because this is a highly leveraged business. So, different segments within the banking sector have come out of the COVID-19 crisis in a phased manner. Some businesses were completely unaffected and therefore they saw a quick recovery and a rebound. Things like housing finance, which in affordable housing basically have continued to do well with maybe like a gap of a year during COVID. Two things like MSME, two things like commercial vehicle finance, which are interest rate cycle linked, basically, and hence they are, as India is growing and the growth for the GDP is basically going up, these sectors have started to do well. We've been looking at businesses and on their behavior during the COVID period, the earlier setbacks, and how their balance sheets have behaved during this period. Businesses which are of exceptional quality, like the Sundaram Finance business, Capital Small Finance Bank, which we just added in the portfolio. Then on the MSME side, City Union Bank, which is probably the gold standard of MSME lending. We've been basically adding high quality businesses which are coming out of these cycles individually and slowly and gradually building our position on them. So over to you, Anubhav.
Yeah. So just to summarize here, the key point we are trying to make is that like we place a lot of emphasis on valuation, buying without obviously again emphasizing that as well without compromising on promoter and business quality. But at any given point in the market, there are overvalued sectors like today defense, renewables, railways, power. These sectors are like very, very expensive and completely overvalued. And we don't own a single companies in this hot sectors because, like I said, we always are able to find some sector that is out of favor at this point of time, and there are good companies in these sectors, and we are able to invest in them. Yeah. Moving on to the next slide. So this slide, we wanted to highlight how we deploy corpus in a staggered manner. So if you look at this chart, this shows how we have deployed uh, corpus for a client who invested in our PMS in November 2023. So last 1 year, as we have been discussing, the markets have become increasingly more and more expensive, and valuation has been sort of a challenge. So that's why we wanted to highlight how we have deployed capital for a client who joined us like around 8, 9 months back. So if you look at this chart, we took almost 6 months to deploy more than 90% of the client's capital. And during this phase, we took advantage of market corrections because on any given day, when market corrects by 2, 3%, small cap companies can correct by 10, 15, or even 20% because they are inherently more volatile. Institutional ownership is low. These are more retail investor driven. So that gives us an opportunity to invest in very high quality small cap companies at good valuations. So we've taken advantage of that for this client. And another thing I want to highlight is that after May, the cash levels have again started increasing in the client's portfolio. This is because even for our existing position, like I mentioned, some capital good companies in our portfolio have become expensive. So we are even very objective about exiting our portfolio companies. We don't have any ownership bias, and we are not gunning for like squeezing the maximum returns at this point of stage in the market. Risk minimization is more important for us than chasing like the maximum returns. So we have been exiting partially in companies that have become expensive in our portfolio, and for all clients in our portfolio, older clients as well, and that is why the cash level has gone up after May, because some positions we might have exited in this portfolio as well. So just to summarize, we discussed that what are the key strengths in our investment strategy that help us minimize risk during a bull run like the current one. So now we'll discuss like what are the implications of this approach in terms of portfolio construction and portfolio performance. So in terms of portfolio construction, the main implication is that we follow a bespoke client portfolio construction. By that I mean is that when a client onboards us, we do not deploy his or her capital in the same set of companies in which we are invested in older portfolios. We always build a client portfolio depending on, firstly, what are the available opportunities at this point of time in the market. Secondly, we look at the market context. Like if the market is overvalued, we will slow down our deployment to take advantages of volatility or correction down the line. We will invest like in smaller amounts in even the opportunities we like, uh, so that we can preserve cash in the portfolios. Lastly, I want to emphasize is that cash is not a drag for us. We treat cash as a very strategic position for us that helps us take advantage of any volatility or corrections. We do not care about near term or relative performance. We are not here to beat the index in the short term every month by 1 or 2%. So because we are keeping a lot of cash, especially in the portfolios that have joined us in the last 4, 5 months, we are happy to underperform the index for these recent portfolios, because what we care about is like over a longer term, 3 to 5 years, we deliver absolute healthy returns for the client. So overall, that is the implication in terms of portfolio construction. In terms of portfolio performance, I think there are two main implications of our approach. Firstly, our like strategy, like it undergoes lower correction during market drawdowns. Secondly, we are able to generate healthy returns for our clients across vintages. And I'll discuss both these points in the coming slides. Yeah. So, like I said, that our portfolios or our strategies suffers lower drawdowns during market corrections. So here we have highlighted three instances during the last 5 years or since our inception when there has been a drawdown in the market. And during each of these three instances, our strategy or our PMS portfolio underwent a much lower correction compared to the overall market. So the first instance is like when the COVID outbreak happened in during March 2020. So you can see that our drawdown or our correction was much lower than the correction in the Nifty 50 and BSE 500 index. Another example or another instance I want to highlight is when the Russia-Ukraine war broke out uh, in like early 2022. So then also there was a decent correction in the market, but our strategy suffered a lower drawdown compared to the Nifty 50 and BSE 500 TRI index. So here we want to emphasize is that to deliver good performance over longer period, like 5 or 10 years, it is very important for a strategy to suffer lower drawdowns during market corrections. This is because during bull run, any company can deliver, like any Tom, Dick, or Harry company can deliver good returns. But it's only when the tide turns, the true, like, that is the true test for any strategy. So I think we have done well on that aspect.
And just to add to what Anubhav is saying, I think the data since our inception for the last 5 years, we've had, if there were X number of drawdowns, monthly drawdowns since inception, we've been lower than, our drawdown has been lower than the underlying index for 95% of those drawdowns since the last 5 years. So the cumulative data also basically backs what we're highlighting in this chart.
Yeah. Moving on. So this slide, like it highlights the returns we have generated for our clients across different vintages. So one point we want to emphasize is that to evaluate any PMS strategy, it is important to look at the returns generated for clients joining at different points of time, because in a PMS, different clients join at or invest at different points of time. So the PMS should be able to deliver healthy returns for the client, irrespective of the market level at which they started investing. So if you look at our performance, barring 2024, and I will explain why is that, during all previous years, for clients starting in 2019, for clients starting in 2020, our strategy has always beaten the BSE 500 TRI index performance. And just another point, I think you can read that as well, that for periods which are longer than 1 year, these returns are IRR or annualized. Uh, in 2024, like in past 5-6 months, for the clients that have joined us, we have underperformed, and I explained that earlier as well, because for especially in the last 4-5 months, for the clients joining us, we have been maintaining quite a high level of cash in their portfolios because we feel the market is overvalued and we are being cautious. So because of that high level of cash, for these set of client, our median returns is lower than the index. But this is like a short-term phenomena. These clients are not even 1 year old. Hopefully, like I said, over longer terms, this cautious approach will deliver good returns for these clients as well. So now we'll just conclude our presentation and take questions. So at this point, we just want to highlight is that the markets have done well, but it is now a time for uh, to be more cautious. Because if you look at several past instances, here we have highlighted 4 instances where when the market becomes very overvalued or when it became too exuberant, an imminent correction happened. So at this point of time, we don't know what the correction will be like. Nobody can know that. Like it's impossible to time the market. So and we don't know when will it happen. It can very well be the case that market appreciates for another 10-15% and then there is a correction, or the correction can be in the form of a time correction that the market stagnates at the current level but the earnings keep on growing and the valuations come down. So we never time the market. We don't know what will happen exactly, and there is no point in that. You can't time the market to exit and then invest when the timing is opportune because you don't know where the top will come and where the bottom will happen. So our suggestion is not that you try to time the market and exit the market and then come later on because nobody can do that. There has been no historical examples of anybody doing that perfectly because nobody knows when the peak out will happen or what will be the exact form of correction. But yeah, we do want to emphasize that we feel that it's time to become cautious. Uh, try to uh, try to follow a disciplined approach. So that is what we want to convey here. So just concluding. So what is our promise in terms of our strategy? So firstly, like I said, our current focus is on being prudent, on minimizing risk. We have become even more cautious about the valuations we pay. We have become even more cautious about doing diligence on the promoters and the business because in a bull market, overall there is exuberance, so you can get swayed. So it's very important to be cautious. So at this point of time, our focus is not on going after the last bit of return or trying to go after momentum and maximize near-term returns. Our focus is on risk minimization. And like I said, we are very strictly, we have become even more stringent about our process and valuation discipline. And we continue to be long-term oriented. We don't care about the next 5-6 month return. We care about whether the opportunity can deliver healthy returns for us over next 5 years, over next 3 years. So continue to maintain that long-term orientation. And lastly, we want to emphasize is that we are not taking this market exuberance as an excuse to just be idle. It's not that we are compromising on our effort or or on our research. Even in fact, we are doing even more research to build a portfolio or list of good companies, uh, ideas, so that we can invest in them whenever the market corrects and presents an opportunity for us. So we continue to be put in our efforts and do a lot of research to be ready with the ideas to take advantage whenever the market corrects. And also we shared what we are doing, but we do have some expectations from our client as well. So the first and most important ask that we have from our client is that maintain a long-term orientation, especially at current levels in the market. Don't invest thinking about I want to make very healthy returns or make the best returns in the next 3 months, 6 months. Uh, that should not be the approach. Have a long-term orientation, remain invested for the next 3 to 5 years because equity by nature, it's a long-term investment instrument. So have that long-term orientation. Second point we want to emphasize is that the recent bull run that has happened, I think that has spoiled a lot of the, especially new investors, because everyone expects that I want to have a 35, 40, 50% return from the market every year. And that is an unrealistic expectation to have. Uh, Please invest in us if you want to, with a very realistic return expectation. because internally also we always tell our clients that a small cap strategy like us should be able to deliver somewhere around 20-25% kind of return over long terms net of fees. And that is the realistic expectation you should also have. Don't come on board investing that we will deliver 35, 40, 50% kind of return, which sort of has become the norm, like expectation or uh, in the minds of investors. Yeah. And lastly, this is a very important point. We feel very passionate about it, that it is very important for any investor to participate in market corrections and not be afraid of them. And this is something only the investor can do. Because we as fund manager can do our job, obviously try to minimize risk, try to lower drawdowns, but even anything you do, drawdowns will happen in the market. And we will also suffer corrections from time to time. But during those drawdowns, don't be afraid. First of all, don't exit uh, thinking like 10-15% correction has happened and what will happen now. And secondly, invest and deploy fresh capital during market corrections, because the biggest truth in the market is that whenever you invest during corrections, uh, that like pool of capital always does well because you have invested at low market levels. Yeah, we always tell our clients to like participate in market corrections. Sonal, do you want to add anything?
No, Anubhav, we're good. Yeah, we're good.
So I think we'll end here. I've talked a lot. I'll just end the presentation. We'll be happy to take questions. Do we have some questions?
Or you can just raise your hand and we'll unmute you. I think that is also an alternative. Yeah. If you have any questions, feel free to raise your hand and we'll unmute you. Dhimant. Anubhav, can you unmute Dhimant?
Sure, just.
Yeah, hi.
I think it's unmuted. Yeah.
Yes, hi. Hi, hey,
Hi,
thanks, thanks, Anubhav, thanks, Sonal. Thanks for sharing this, very fascinating. I was just curious to know, how do you start thinking at the top of the funnel, saying which are the sectors you should start looking at before you narrow down into the companies? Do you guys look at, like, is it like macro trends saying that, look, the next 5 years is going to belong to consumer durable, or the next 6 years are going to be automobile, and hence we take that sector and then go deeper? Or is it agnostic of sector, but just looking at companies and then forming that decision?
So I'll take a first shot at it, and Sonal, please add So, Dhimant, we are not a top-down investor at all. We are very bottoms up. So, and why is that? Is that whenever you look at any tailwind, whether it is like maybe renewable or EVs, those tend to get baked in the valuations very quickly. And we have seen that it's very hard to be ahead of that. Like all the story of tailwinds and all, firstly, they get baked in very, very quickly. And secondly, what also happens is that when you chase tailwinds, now what we have seen is that sometimes these tailwinds, especially in a country like India, they sort of taper out. They don't play out.
They don't play out.
They don't play out according to their initial promise. So we are very careful of chasing tailwinds. What we do is that, I think I just touched upon it, but I'll explain that at any point of time, we do have a very wide coverage. So we are aware of different good companies run by honest promoters in different sectors. And obviously, we do our work on the sector as well. That we do look at industry tailwinds, but that is in context of how the business will do over the next 4 to 5 years. That is not a top-down approach that we will take up renewables and try to invest in 5 companies in that hot sector. It is always bottoms up, that this is a company that has come into our list because it is run by a good promoters. We have tracked it for past 4 or 5 years, and we can see that now it is available at a good valuation. And then we do work on the industry to see how the industry will also do in the next 4 5 years. But it is always bottoms up for us. We do our work and we see it is available at a cheap valuation, and typically that only happens when there is some temporary issue with the industry or particular sector. But it's always a bottoms up approach, not a top down.
Got it. Thanks for that.
Just to add to that, Dimant, when we are talking to these founders, I think a lot of these people, as we say, they are reinvesting their capital in R&D, their product, their expansion. A lot of tailwinds which are not covered by the media, which are not covered by the analysts, basically are micro in nature, not macro, basically, as Anubhav highlighted. We understand their micro tailwinds. And I think the media, the research analysts, and nothing wrong, they have their own job to do. We have our own cutout to do here. We focus on the micro tailwinds which are relevant to the PNL and the earnings of that particular company. And therefore, so for example, we talked about Jyoti Laboratories, right? They are trying to become from a, let's say, a regional single product dominant company to a multi-regional, multi-product company, and investing in people and products, basically. Now, this is a tailwind that nobody wants to talk about in the media, but this is the tailwind. So our definition of tailwind basically is something which is specific. But on the other side, as Anubhav highlighted, like we've been looking at auto anchors for 10 years, not because auto anchors may EV ki life, EV will be the next tailwind. We've been tracking them to say, what is it that they're reinvesting in? And when we've seen that everybody invested, let's say in exports, that was one tailwind. Everybody's invested in building different product lines for EVs. That was the next tailwind. So we get the soundbite of the tailwind bottoms up, which is relevant to the PNL of the business.
Got it. No, thanks, man. That's super useful. Thanks.
Alankar, I've unmuted you. You can ask. Yeah.
Thanks, Anubhav, and thanks for this overview of your strategy and the rationale behind it. It was quite helpful. So my question is on the US Fed rate cut cycle. So how do you think it would impact the Indian markets in the coming next 6 months or any vintage of time?
Alankar, I'll be very honest firstly in saying that we are not very macro driven strategy at all. In fact, I tried to make that point that macros are quite irrelevant over longer term, because that is the point I wanted to make. And even like the Fed rate cut will definitely be a positive. Like obviously falling like lending rates are a positive for the equity market. Your return expectation lowers during a lower rate cycle. So it will be a positive for US, and I think India also inflation has come down. I think the RBI will also cut rate eventually. So it will be a positive for the equity markets. But I think any macro event like this, these tend to be short term in nature in terms of their impact. Maybe 3-4 months they might cause some buoyancy, or the markets might react positively. But beyond 3-4 months, it's always how the business performs, how the particular company is doing, that becomes more relevant. And our focus is mainly on that. So we are not experts at predicting like macro impact on markets at all. Yeah. So now please.
No, that's fine. And another thing I wanted to ask is, you mentioned on the last slide that you want your investors to be proactive and like take benefits from these market corrections, right? So my question around that is that as the fund manager, would you be like nudging us that, hey, correction is around the corner, or we are undergoing a correction, so it's a good time to deploy additional funds or something like that, or we have to proactively do that as an investor?
So thanks for that question, and I think it's a great question, and it helps us highlight one point is that I think everyone has their own strategy, and every strategy performs well in the market at different points of time, and there is no strategy that can make that claim that we are the best, and neither do we make that claim. But I think one claim that we can make very emphatically is that we are one of the best in terms of our communication. So we have different modes of communication with our client. We provide firstly a web login and a mobile app login so that our clients can track their portfolios at any point of time. Secondly, and there are some clients on this call and as well, they can vouch that we share a monthly, very detailed monthly newsletter to all our clients. And that is a discipline we have maintained since our inception. Every month, we will send out a very detailed note that highlights what we are thinking about the market. And in those monthly updates, whenever there is a correction, we always nudge our clients that now is a good time. Please see if you have any and another thing I want to add here is that many clients don't know, like in a PMS also, just like in a mutual fund, you can do a SIP, you can do a follow-on investment of any size. The initial investment has to be 50 lakhs, but a follow-on investment can be of any size. So we have proactively at multiple times when there has been a correction in the market and we felt that now opportunities are available. Again, I'll take a particular example. The period between March or even January 2022 to March 2022, it was almost a 1 year, 1.5 year kind of period when the markets were sort of stagnant and the small cap space had corrected like by 15-20%. And during that time, we had at the start of that period only, I remember very well, even between the month, we had sent out an email communication that we feel now is a good time. Markets are down, specifically small cap companies are down. Please, if you have any corpus, please invest. So I think we pride ourselves on that we always nudge our clients. We are in constant communication that please take advantage of this correction. Yeah.
Just
So
to
now,
add to
please
what
add, yeah.
Anubhav was saying, during that period, markets were down, the earnings were rock solid, and I think like we have our own limitation in writing it. Maybe we don't call our customers to say top up, but we do write to customers and say this is the best time given the logic, and you should top up, and the rest is left to the customer.
Yeah, calling I think is too intrusive as well. Personally, I feel like an email should be fine. Yeah.
Yeah, we write. That's all.
Okay.
Prakash, yeah.
Yeah, I'm just. Oh,
Yeah,
uh,
hi. Yeah, hi. So I have three
Prakash?
questions.
Yeah,
Yeah,
we'll
this
go
is
with
Prakash.
you first. Oh, sorry, here.
Yeah, can I go ahead?
Sure,
Yeah,
sure.
Prakash, please.
Yeah, so I have three questions, right? So first is do you kind of factor in like industry specific analysis? So for example, like broadly you mentioned that you're looking at high return on capital and low debt kind of companies. So that is kind of applicable for, let's say, the traditional industries. But let's say when it comes to areas like financial services and so on, there could be other parameters like return on assets and so on. So do you have a mechanism to factor in, the appropriate matrices for, various industries and so on? And do you continuously evolve your theories around that?
Absolutely. And I think I did mention it that barring financial services companies, when I was talking about net cash on books, it was clearly barring lending companies. And obviously, one thing again I want to highlight is that we have a very wide coverage. We are barring one or two sectors like real estate or global cyclicals like steel, oil and gas, steel, where like something happens in China and Indian markets are disrupted, because those are very hard sectors to follow. And real estate mainly because inherently the business model can't generate ROEs. It is a asset driven model, like where you have a land bank and your valuation comes from how much your land bank is valued and things like that. The focus is never on generating ROI. So barring the like very few sectors which we don't touch at all, we have a very wide coverage. Sunal and I have an extensive investing experience across many different industries, and those matrices that we talked about, these are top down one or two key matrices that we look, which we feel very
Sure.
strongly about, because leverage is something we feel strongly about. Like
Sure.
we try to avoid companies with high leverage. I think it brings about fragility in the balance sheet. But we have very deep thesis, understanding, tracking of several different sectors. And I think it's very important to track that, because in India, what happens is that the regulatory landscape changes a lot. Competition is sometimes insane. There is always a risk of new age technology companies coming into your sectors and disrupting you, because those are heavily funded. They don't have to care about their P&L. So I think we pride ourselves on tracking different sectors, companies very stringently. And we have a wide coverage, and we have very sector specific KPIs that we follow. And especially Sonal, he will add, he has a very deep understanding of lending businesses. Sonal, do you want to add to that? Yeah.
No, I think Anubhav explained, Prakash.
Cool.
Basically,
Yep.
this slide was more for the deck. Basically, therefore we have
No,
to
no, I
use
understand that. Yeah.
lowest common denominator there. But let's say financial services, uh, we go to the nuts and bolts. We have a way to benchmark. Let's say if there are 60 roughly thereabouts lending businesses in India, we squeeze them down to our KPIs and say good, bad, ugly, growth, whatever. This is what we want to look at in terms of KPIs. And if you don't fit the bill, no matter who you are, who's backed you, it's not relevant for us. And therefore, and sometimes there are businesses which people don't like because they're too small, but if it fits in our bill, it fits in our bill. So
Sure.
deep industry specific KPIs for financial services, for auto anchs, for I would say consumer, for IT,
Mhm.
and pharma. I think pharma is a very difficult sector to understand. You would appreciate that. And basically, Anubhav, he's been tracking pharma, which most of the analysts just highlighting. Most of the I think analysts and the investor community say we don't want to put that effort. So
Mhm.
we cherish that basically as well. So
Sure.
that's
Understood. So great. Thank you. So, I mean, to basically, you do have like, I mean, you stick to the sectors you understand, and some of you have its hypothesis on which ones to avoid and which ones you're confident about overall.
yeah.
Yeah, and on that, Prakash, it's like when I took some particular industries, like again, I would repeat real estate, global cyclicals.
Yeah.
Those, like I said, those inherently have a problem again because we understand the business model. Because real
Sure.
estate, if you look at it, none of the listed companies care about free cash generation. They would always go and in fact, real estate, if you look at project level, it's actually a very decent business. Gross margins are high. At a project level, you tend to generate very, and it's actually negative working capital business because, like, even at the launch of a project, they take money from you up front. But the
Yeah.
problem is that project level IRRs are good, but what real estate companies will do is that they will take out the cash and then invest in buying land. So they will have like 20 years of cash of invested in like land bank for the future on their book. They can, inherently there are some business models which don't fit our bill, but we are very open to like looking at new sectors like yeah, we are invested in Just Dial, which is a new age classifieds business, and we
Sure.
do track Zomato, all of these new age businesses. Obviously, we can differ in terms of like what valuation we will pay and things like that, but we do understand and try to work on new sectors, businesses. It's only when we understand the business model and that business model doesn't fit our criteria, then only we don't invest in it. Otherwise, we are very open to evaluating new sectors, new ideas. Yeah.
And to add to that, Prakash, just to explain, like real estate, taking an example, we understand there is a real estate boom. We don't want to invest in real estate companies, but we have a very deep insight onto the building
Building
materials.
materials.
Yeah,
Yeah.
Yep.
in fact, we were, I think, back in our earlier employer, basically, we were the first one to meet Sera, which is like the best run building material business in India, basically, in terms of promoter quality. So we know, very simply say, we know how to slice the onion, basically,
Yep.
and how to peel it, sorry. And we don't go by tailwinds. We don't go by businesses which basically have bad promoters, bad return on capital. But if there is a different way to peel the onion, we will.
Okay, understood. So because others are in queue, I'll just ask the second and third question quickly. The second was about, the promoter quality and corporate governance, right? So if you can throw some light on how exactly you go about assessing that, maybe in short. And the third question was really around, do you also offer overall tax planning and succession planning, kind of advisory as part of your, to your clients basically. So that's
I'll quickly answer. The answer to third is none. We are pure play investors. We can refer you to people who can help you with tax planning, but that's not what we get to the table.
Okay.
Thing on the second part, basically, sorry, I missed the question. Sorry.
I think
it was about promoter quality and corporate governance.
Promoter quality, yeah. So 50 to 60% of our time basically is spent on assessing promoter quality. To simply answer you, if there are 5,000 listed companies in India, we've drilled down this to a list of 320, 330 odd companies between Anubhav and myself. We think whose promoters are backable, and we keep on expanding and contracting that list. That list has been brought down to that number based on both quantitative and qualitative assessment of these promoters. When I mean quantitative, this is linked to their disclosures in terms of their corporate governance, their capital allocation history, their related party transactions, their other businesses. And the qualitative is us having met them repeatedly over the last 15 years. And we continue to do that exercise. Promoters we like, we end up meeting them or talking to them like once a year, twice a year. And once you accumulate this, you build a good gut feel about a promoter, their intent, their business quality, their next level team, and their capital allocation history. See, the most important thing here, Prakash, what we're trying to do is that the guy does what he explains to you. I think and that is the gap between the lip and the cup. We back that by data and say, has he done this in the past, what he's saying? And secondly, is his behavior in sync with what he's saying? So broadly speaking, these are the two ways in which we come to the answer.
Understood. Good. Thank you. Thank you very much, Saurabh.
Yeah, and just I'll take one minute to add to that. That when you ask like what do we do, I think we do a lot of diligence, a lot of primary research to make sure the promoter is firstly crystal clean, no corporate misgovernance. Secondly, very driven and very motivated to deliver the best for his business, grow his market cap. So we do a lot of stuff. Like we will talk to all the competitors in that space. What do the competitors feel about this business? And believe me that most of the time competitors are quite honest. If there is a good company, they will say that I'll tell you an example. Like in plastic pipes business, any company you speak to, whether listed, unlisted, they will always tell that Supreme and Astral are the best in the business. So they are very honest in giving that feedback. So we do that. Secondly, we will talk to current employees, ex-employees, employees of competitors again to get an understanding of what does the promoter do differently. How are they trying to build some sort of a differentiation in their business approach? And those can be very simple things. Those don't have to be rocket science. Like sometimes the employees tell us that they take us annually on some event and we like that. That keeps us more motivated. Then we talk to the channel, like distribution channel, distributors. We talk to their retailers. If it's a like B2C kind of business, that how are the terms of trade that this promoter offers you, whether they offer you fair terms of trade or not, whether like they pay you on time or not, what type of promotional schemes do they run from time to time. If it's a B2B business, like an auto ancillary, we will go and ask the people like a plant manager in the OEM, like I gave you the example of VM. So, and that company we have been tracking for now 10 years. First, we met them in 2014. So any business typically we invest in, we would have tracked that for at least 3-4 years. Only then we have that much comfort and conviction in the promoter and business quality. So when over the time we have talked to multiple plant managers in TVS Motors, in Honda Motorcycles in India to get feedback like what do you feel about this company? Do they like Do you like trust the quality of products they deliver? Have they shown innovation over time? Do they like are they able to design the right products for you? So whether it's a B2B business, B2C business, we do a thorough diligence across employees, across promoters, across customers. Only once we are convinced, then we invest. And even after investing, we continue to track. Like because in India, again, like I said, no matter how much work you've done, your thesis can get challenged because of irrational competition in the industry, because of some regulatory issue. And the first uh, instance where we see that the promoter is goofing up or there is some structural challenge to the business model, we don't have any ownership bias. We would like exit it immediately. Yeah.
Great, great. Thanks, Anubhav.
Uh, Kanav, you
Yeah,
can go on. Yeah.
yeah. Hi, Anubhav and Sonal.
Hi.
So I think so. In the presentation, you talked about financial services being not in favored right now in the market environment, and you are finding them to be cheap. So just on that thought, two questions. Basically, what percentage of your portfolio is in financial services right now? And secondly, do you think the cheap retail deposit which happened for 20 years, which went on, which funded these banks' balance sheet and allowed them to grow and expand their return on assets, would that go down now because of digitization, more awareness, people moving retail money moving away from banks to other avenues? So just thought, is this a cyclical thing that is happening right now where banks are not getting deposits, or do you think there might be a structural aspect to this and they might have to raise deposit rates?
So, answering your second part, Kanav, see, getting CASA has been so I have been, I think, looking at financial services for since 2007, 8, and whatever people, bankers we've spoken since then, I think getting CASA was a problem back in 2004, 5, and it is a problem getting even CASA now. Banks have to compete. Like, say, if the CASA pool has grown from 100 rupees to 500 rupees, it is a heavily competitive pool. It was a very competitive pool back then. It is a very competitive pool now. You'd be surprised to see that people love digital means to interact with the banks on the asset side, but on the liability side, people are very, very conservative on where they want to park their money. They prefer physical banking for uh, for that part, and that is the need for basically banks to grow their retail branch network. So what we have seen, and I think good that you touched upon, our first premise of any deposit taking business, if it is allowed to take deposit, is that how strong is the liability franchise of that business. Anybody can do asset financing well, given the team, whatever. We believe the liability franchise is a more difficult business, and whosoever has been able to build a good liability franchise over time, if they're allowed to, uh, we value them in gold. We value them better than the others, and some of those names basically are in the portfolio as well. Our thesis basically starts of assessment of any franchise, any NBFC, doesn't start from the asset side. It starts from the liability side. And trust me, there are some companies, there are some banks, for example, IDFC First, leave the asset side. I think what they have done in the last 5 years in terms of their CASA buildup, HDFC, Kotak, Axis, ICICI have not been able to do. Now, what have they been able to do? They've been able to create a good retail branch network. They've been able to create a good platform, both on the asset side and the deposit side, basically. And they have been able to get CASA at 7% interest rates. Everybody can do it, but they've been able to do it better than everybody else. Is it sustainable for their business model? It is, but that's specific, basically. So CASA is important. At this point in time, the CASA basically has squeezed because during COVID, I think people saved a lot. Behaviorally, people wanted to save money for the rainy day and any medical emergency. That part, I think, has died out. But if you look at the big retail franchises, SBI, HDFC, ICICI, IDFC First, Kotak's, there are, I think, some 10 names basically who have been able to and who are always able to get I think the car and the SA. TD is the next bit, the term deposit. But these, and therefore, I think their cost of deposits, their CASA ratios basically stand out compared to the other names. That's the answer to the second part. We are investing in banking financial services. We have been investing out of COVID during banking financial services. As we speak, I think banking would be between 15 to 20% of our fund, basically.
Basically, you're slightly underweight.
And kind of just to add, and I'm not a financial services expert. Sonal heads that sector for us, uh, between the two of us. But just want to add, I think that is the wrong impression many people have, that the CASA like buildup is being challenged because of the bull market. If you look at the SIPs that are happening, that are nothing, like 10,000 crore net SIPs are coming into the market. That is not taking away the flow into like bank deposits and bank liability side. I clearly, like, there are other factors, like financial savings of households in India has gone down drastically, because the main issue is that like Indian household income is getting challenged. Like like unemployment is rampant, rural sector is in distress. If like the recovery since COVID has been very K-shaped. Like some parts of the economy have done well, who were anyway rich, the rich have become richer. But overall, household savings are at their all-time low. Household liability has increased. So I think those are the more challenges, rather than like money is flowing into markets. I think that's a wrong narrative. So, and that is cyclical in nature, hopefully. Like if we believe that India will do well, and one has to be optimistic about that. I think the savings will go up, and I think RBI is already clamping down on the liability side. They have come down very heavily on personal lending. Look at the kind of regulations they are bringing in, even in terms of fintechs and all. So I think that is more cyclical in nature rather than with something being very structured. Yeah.
Thanks for the input. I think so. If it's a structural, it's not a structural thing, then I think one of the cheapest sector right now in the market.
Yeah, I think it is. Yeah, we definitely believe it's cheap. Yeah. Any other questions?
Sunil, I think.
Okay.
Oh, sorry, from Karnataka.
Okay, I think, yeah, Sunil, please go on.
Hello, hi Anubhav, hi Sonal. Hey, thank you for this presentation. This is really insightful into your strategy and the process. A small aspect I want to talk about is about the tax hike for the short-term positions. So how much is your portfolio turnover ratio, so that we understand the impact of the hike in the tax, the STCG?
Yeah, we get that the STGG has been increased. So we have a very low portfolio churn. I think in a given year, our portfolio would churn by maximum 20 to 25%. We none 5-6 years we have been in existence. I think the portfolio churn has never gone above that. And Sonal, do you want to add like how many of our portfolio companies are like, yeah, still we are holding on?
So we've been holding on to, I think, if so, the first vintage of customers, like 15, 16 companies we invested in, we're still holding on to 7 of those 15, 16 companies. So you can do the maths, and we've been building. So not holding, is we've been building our position on those 6, 7. They are, some of them Anubhav mentioned in the presentation, are as multi-backers. So our portfolio churn is extremely low. It's been 5 years. We would maybe another 2 to 3 years, we would have reached 1x portfolio churn. So you can do the maths. 1/6, 1/7, whatever the number comes out, is actually the churn for the portfolio in a given year. We build a portfolio of 15 to 18 companies. On a numeric basis, we may churn out 1 or 2 because of underperformance, or us wrongly analyzing a particular sector in terms of what we've assessed. But the count is 1 to 2 out of a portfolio of 17, 18 companies.
Anyway, we are a buy and hold strategy. Clearly, we are very like, we truly believe in buy and hold. Like we can give some examples as well, like FM Industries, and I think that is also an aspect of our portfolio companies is that like when they do well, their earnings grows, the valuation is in check. Even FIAM, you can go, FIAM Industries, you can go and check on screener.in. Even today, it's trading at some 22, 23 times trailing earnings. For a company like which is the highest dividend payout in auto ancillary space, net cash company, ROEs you look at, the kind of growth it's delivered. I'm not saying 22, 23x is like a fair, like cheap valuation, but it's pretty okay given the kind of markets we are in, like where you will find very poor quality names trading at 40, 50x. So what happens is that till like clients who joined us even a week back, we were able to invest in FAM, we were able to invest in a lot of other companies, like some in the pharma names, like I could take on, but I don't want to discuss individual names. But we have been able to like invest in companies over 5-6 years, even for newer clients who come in, because like for ideas that do well for us, and if the valuation is still like fair, may not be cheap, but fair, and we believe the growth prospect is there. It is a management that has delivered for us. We have high conviction, high belief in what the management says, because we have seen the management deliver. So we follow the policy of like concentrating and increasing allocation more and more in our winners. So that's why also like the portfolio churn is less.
Understood. One more question, Anubhav. I believe you have assets under management of roughly around 200 CR, right?
Right now, I think it's reached
270.
Okay. Where do you see the scalability constraint? At what level do you think you will stop finding the opportunities in terms of investable ideas? So what's your target in terms of assets under management for next few years? And so that you're able to give the good returns, but there's a scalability limit also, right? You cannot scale above that.
I think, and we have thought about that, and it is a relevant question. I think, given like if you look at the overall Indian equity market, and like it is also scaling up. Like the overall size of the market is not the same as it was like 15 years back. I think in one of the memos we highlighted that as well, that the average market cap of a small cap company has moved from maybe 1,500, 2,000 crores in 2008, 7, 8 timeframe to around 4,500, 5,000 today. So I think given and today even at 280 crores, there is we haven't even faced any opportunity where liquidity has become a concern either when we are buying or selling. So I think our strategy would work, definitely keep on working till around 1,000 crores of AUM easily, maybe slightly more than that, because the size of an average small and mid cap also has moved up. It's not like today what we define as small cap company is what it was 15 years back. So I think it will definitely keep on working till like 1,000 crores, slightly more than that. Beyond that, maybe we will have a challenge, and I think we'll tweak our strategy when we reach that stage, because honestly, that is a journey that is still, I suppose, some years away, and it's a good problem to have. If we reach 1,000 crore, 1,100, 1,200 crore AUM, like it's a good problem. But I think till that point, I don't see an issue at all. Sonal, do you want to add to that?
Yeah, and my number is a little higher, but I think just justifying what Anubhav is saying, basically, when our earlier avatars and SEF partners, we've seen us, people like Nalanda, people like Westbridge, invest in similar strategies. And with an AUM, our AUM we used to manage back then was 800 CR. That 800 CR is equivalent to, I think, easily maybe 1,500 CR. I'm just throwing a number out. And people like Nalanda, Westbridge were managing basically like more than $1 billion with a similar strategy. We honestly, it's a good problem to have. We don't worry much about it. Back in those days, we used to work on getting blocks. I think when we grow to 1,000, 1,500 crores, we'll have to work closer to getting blocks in these small companies. But that's a more mechanics issue for us. We've seen that in the past. We've done that in the past. I think it's okay. Maybe our concentration will become higher, maybe, or let's say the count of companies will become higher. we'll have to figure out, but it's not something I think we worry much about, basically, to be honest.
Especially at this point of time. Yeah.
Yeah, yeah.
Clear. Okay, I don't have any further questions. Thank you.
Sure. Any more questions?
Is it? Okay. I think I don't see any more questions. So thanks everyone for taking out time for this, and we want to make this a more regular affair. So hopefully we will be conducting a webinar on any like relevant investing topic that we feel about once in 2 months or something like that. So thanks for your participation and thanks.
Thanks everyone. Thank you.
That's wonderful. Thank you.
Anubhav?
Thanks.
Should I
Anubhav?
end? Yeah.
Yeah, end the recording, and there'll be a YouTube link and that as well. Yeah.
Okay, how do I do? Can you like make yourself the host and do that?
You have to make me the host. Sorry.
Okay. Done.
You are the host now. एक पहले recording बंद. ठीक है.